Well, welcome.
Yeah, thanks for having me, Heather.
One quick second.
Sure. Perfect.
All right. Well, good to see you.
Great to see you too. How's everything going on your end?
I'm glad we were able to connect. How's your summer been?
It's been so busy.
Yeah.
I can't believe how fast it's going. And then for us down in Florida, we have our fingers crossed so we avoid the hurricanes, over the next 4 to 6 weeks. Because last year was a doozy for us. So hopefully we're spared this year. So we're all watching the weather and hopefully no major issues. Fingers crossed.
I think I would go through one of those storms and I would move.
You know what? We thought about it. It's true. Especially last year, we had some damage. We actually had somebody over today who was helping to fix damage from a year ago.
Oh my gosh!
It's just been crazy, but all is good.
Well, let's get started here. For everybody that is logged in, welcome. My name is Heather Dreves. I'm with Central Lending, and we are lucky enough to have Craig Feldmeier with us today from Money Ripples, and we're actually sitting here talking about that he is hoping that they do not get hit by storms in Florida, and I am in North Idaho, hoping that the forest fires go out soon. So I think you trade one natural disaster for another, none of which are pleasant by any means. So
very true.
We will pray that you guys do not have storms like you did the last couple years for sure. But thanks for being here.
Absolutely. Thanks so much for having me. Look forward to talking about alternative assets.
Yeah, I'm excited. So this is Craig Feldmeier with Money Ripples. Craig, you've built a career advising clients on how to diversify their portfolios with alternative investments. It's a hot topic right now. I have to say I've been in this space for a while, over 20 years, which is aging myself. And it should be an indicator of my age. I just had my first son get married this summer, so that was our big excitement. And I joked that last weekend my husband and I weren't sure what we were going to do for the weekend, and we went to our lake place by ourselves, just the two of us. And I said, I have a wedding hangover. Like, my social battery is on zero, so we went and recharged. I wanted to be fresh for this. So it's perfect timing. But before we dive in, share a little bit about your background, what led you to focus on alternatives, because it's pretty interesting. You weren't always in this space, so maybe you can expand on that a little bit so that our viewers know a little bit more about you.
Sure, would be happy to. So I actually started my career in New York City. I worked on Wall Street, and I started in a really tame year in the financial markets. It was 2008. I'm not sure if you remembered kind of what happened around that time frame. For any of our younger listeners, that's when we had the great financial crisis, right? And I was kind of in the heart of it in Manhattan. My first job was actually securitizing mortgage-backed securities, which was really kind of the catalyst for the chaos that ensued really over the next 24 months. And I was a young guy just kind of getting my feet wet. But what I observed, Heather, was just absolute chaos in the markets. My bosses, I remember talking to me, how literally their 401k basically got cut in half over the span of a few months. And, it took a few years for, the market to recover. But that was kind of my first, real experience to, okay, the stock market, while it does have a lot of benefits, can be really volatile, right? And is that where I want to put all of my investments, right? So I kind of had that thought, maybe it's a good idea to diversify, right? And so actually, I was a private banker for about 8 years and focused on kind of more traditional finance, traditional asset allocation, stocks, bonds, mutual funds, high yield savings accounts. But in the back of my mind, I always was really interested about real estate, right? And specifically about cash flow, right? Because I always had this, this mindset, okay, it's great. I'm building assets. I'm in the stock market. It's going to be volatile. How much money am I going to need when I want to retire, right? It was really tough to get really certain about what those numbers looked like, right? And so I said, okay, maybe I need to build some cash flow, right, on the side. So, I was in Manhattan. this is a great rental market, right? Because there's so much demand and rents are so high, right? And I quickly realized Manhattan was one of the worst places, especially for a new investor to get started. And that's kind of what started my thought process in regards to alternative assets. That was probably 2016 when I really got serious. And then fast forward to 2025, I've kind of left the traditional world behind and am 100% into the alt space.
That's exciting. And correct me if I'm wrong, you actually were turned on to alternatives through podcasts as well. You had a little bit of exposure through that?
Absolutely. So I found, the Money Ripples podcast with Chris Miles. He's the CEO of our company and has been an amazing mentor and friend to myself. So he was one of the original money podcasters. And this was, probably 2014, 2015, when I started listening to the Money Ripples podcast. Chris and I connected, first as friends and mentor-mentee relationships. And then, fast forward to about 2021 when I was able to join Money Ripples. And we've grown a great business, over the past 4 or 5 years.
That's a cool story. And what I do appreciate about you and Chris as well is that you aren't just up on a soapbox, screaming, everybody pull your money out of all these traditional options and move everything to alternative. I think you guys do a really good job, balancing that and giving people good advice.
I appreciate that.
Define what exactly is the definition of an alternative investment, because I think there is some misunderstanding out there and people are somewhat confused by that at times. Can you expand on that a little bit?
Absolutely. And it's a great point and a great question. And I would say an alternative investment is going to have a different meaning to different people. The way I define it, Heather, would be an asset that's going to generate yield, whether it's cash flow or whether it's growth or maybe a combination of both, that's outside of the traditional stock market. So if you go on to, say you have Vanguard or Fidelity as a brokerage platform, that's how you buy stocks. If you want to make an investment and you cannot do it through Vanguard, then it's an alternative asset.
Okay, that's great. I think that's an easy way to remember that.
Mm-hmm. So it's like if you can go on your brokerage platform, type in Tesla, right? TSLA, buy some stock. That's a traditional investment. If you want to do something non-traditional, right? Whether it's to buy an investment property, to buy a structured note, investments in gold and silver, oil and gas, those would be something you'd have to find on your own, right? Or through a community. And those would be what I would call alternative assets.
Okay, that's helpful. Hopefully you guys think that's helpful too, because I get asked that a lot. I also think another buzzword we hear out there is diversification, and people throw it around, and a lot of times, and just for clarification, I don't give financial advice, neither does Craig. We are not financial advisors by any means, but people ask us a lot, diversification, what would you do? What should I be doing? And sometimes they don't even really know what that means. So maybe expand a little bit about, what diversification means to you and your community.
Absolutely. And I think it's critical to, when you are looking at your assets, right, there's not a one size fits all solution, right? And one of the things that turned me off from, a traditional, investment brokerage house was that the companies will have, a portfolio, right, based off of your risk tolerance. And whatever your risk tolerance is, they kind of, it's kind of like a paint by numbers type of asset allocation. And to circle back to diversification, right? So to me, diversification means you don't want to have all of your eggs into one basket, but we can even expand on that. So what does that mean? That means you don't want to be with one, if we're talking about alternative assets, you don't want 100% of your money with one investment operator. But to expand on that as well, you also don't want to have 100% of your money into one asset class, right? Yeah. So, say we were with, say you're a real estate investor, right? And you love single family homes. And you think, okay, I am going to buy all my houses in Tampa, Florida, where I live, right? And maybe you have 10 houses all in Tampa. You might think you're diversified because you've got, your assets spread across 10 different investments. But what if a hurricane comes through, right? And your portfolio is flooded overnight. You might not be so diversified even though you thought you were. So it's really kind of looking at your assets, looking at your balance sheet, and making sure that whatever assets that you have are not very correlated to each other, right? So if something happens in one market or one industry or with one operator, you're able to weather that storm, right? And then you can even say on the traditional side, right? If you're looking at your investment portfolio, if you're on the call right now and you have a lot of assets in Apple, in Facebook, in Tesla, right? You might think you're diversified, but that's very heavily correlated to the technology sector, right? So if something happens and the tech sector gets hit, you're going to see a big swing in your portfolio.
Yeah, that's a really good point, because I think a lot of people think of diversification, at least in the alternative space, amongst operators, right? If this operator starts to have challenges, well, I've diversified over 5 of them. And it's quite often that I start talking to these people and realize, they're in 5 different debt funds, or, they're with syndicators that are in multifamily, and they believe they're diversified because they're with, several of them. So that's a really, really good point to point out. Because
and I'll piggyback. And I'll piggyback on that too. And I've seen instances, Heather, where people are way too diversified, right? So if you have, there's a fine line between making sure you don't have all your eggs in one basket and also making sure your eggs aren't spread around too much. Because if you have 20 different funds, right, the odds of an issue happening with one of those funds is going to go up. And then just the administrative nightmare that can ensue. Typically you're going to have to get K1s for a lot of those investments. Come tax time, that can be a mess. It can be, I really preach education and due diligence. That's what we talk about at Money Ripples frequently is, do you understand your investment? Have you done the right due diligence? And we spend a lot of time on due diligence. We ask a lot from our clients in terms of doing the right research, and I think that benefits them in the long run. So once you do the right due diligence and you do have the education, I think it is okay to have a significant portion of your assets with one person, as long as you understand what the risks are. That said, you never want to be too overly concentrated.
Yeah, no, great points. And I encourage people to do their own push-ups as well, and I will say the members of your guys' community that we've had the luxury of working with are very educated and they ask the right questions. I've been interviewed by one of yours. I'm going to interview you. And I think that was the first I said, but they come armed with their questions, because I have to say, I've talked to a lot of people over the years, and it's shocking to me the amount of people I have spoke with that don't ask any questions. And it's like, I'll say, maybe you should ask this. This is things you should. And I love talking about due diligence, because whether you're doing due diligence on me and Central Lending or another operator, these people work hard for their money, and they should be asking these questions, and they should also know, this is one of the other things I empower people is, know what is a hard no to you. And I don't think people think about it. They think about all the questions they should ask, but what are the red flags that are just like, no, I'm moving on to the next operator. So you guys do a really good job with that. I like the way that you guys educate your clients. What do you think some of the biggest misconceptions with your clients are, or an investor in general, about alternative investments?
I'm glad you asked this one. And I'll say this across the board for any investment, there's no free lunch. Right? What does that mean? If you see an investment that's too good to be true, it probably is, right? Yep. So what does that mean for anyone listening to this live stream? I would say on the alternative side, you really want to understand how yield is generated. So what does that mean? That means if someone is talking to Heather and Kate and the Central Lending team, and you're talking about, say one of the funds, and you're saying, okay, we can provide a fixed rate of return of 11% annual return, pays out monthly. Fantastic, right? I love those numbers. A couple questions come to mind. Number one, how do you guys make sure that you are able to provide 11% return to your clients? is question number one. And then number two, right, as a passive investor, I say to myself, does that seem reasonable, right? We don't need to work at central lending to understand, the really intricacies of how you guys make money, but we have to understand enough to say, does 11% seem reasonable, right?
Yeah.
Does that make sense when I'm investing my dollars? If I was talking to you for the first time, Heather, and you said, okay, Craig, based off of what we do, our fund's going to return 20% annual returns. That would cause me to really pause and say, okay, 20%, wow, that's a big number. How do they do that, right? And so I've talked to a lot of our clients, and they'll send me decks and PowerPoints of deals that, they're reviewing. And, when I see some really big IRR numbers, some really big return numbers, my first question is, how is that supported? And can you get comfortable with those return assumptions?
Yeah, I love if it seems too good to be true, sometimes it is. And chasing yield gets people in trouble as well. And it's hard, everybody wants to get the best return on their capital as possible in the safest environment. I think that's the key to it is, to your point, is it reasonable? And I think understanding how a fund makes money, and I tell people this, I said, we're not a nonprofit. I mean, we are all in this industry, in this business to make money. And it's okay to ask an operator, how do you guys get paid? And I'm shocked at the few amount of people that actually ask that. I mean, it's actually part of our presentation to our investors.
Sure.
But, to your point, we have a debt fund. We offer fixed rates anywhere from 8 to 12%. And I think the very few people other than people in your community ask, well, if you're only charging a borrower 10 and 11%, how are you guys paying us 12? And I'm like, thank you for finally asking that. They don't understand that our model is to originate debt, sell the debt off, retain an interest strip. We make money off of origination points. We also charge borrowers fees and things like that. So there's more of a story. But I think people just really chasing yield is the easiest way to explain it. They want to get the highest return on their capital, which I understand. I feel that way too, but I also want it in the safest environment. So really good points.
And just to piggyback on what you said, because you say it so naturally, it probably doesn't even, you don't really even give too much thought. But to anyone listening, Heather just did an incredible job of explaining how central lending makes money and how they pay you as an investor. When you're doing due diligence, when you're talking to a new operator, I was actually talking to an operator doing some due diligence. I won't say the name, but a very well-known operator to anyone invested in real estate. And the person I spoke to was not able to answer that question with the same ease and detail as you just did, right? Which was, how does the fund make money? And then how do we get paid as investors? And that gave me pause for concern, right? Not saying I wouldn't invest with them, but I would do some more work. Just being able to say, yep, this is how we make money. These are the fees we charge, and this is how we're able to pay our clients. That to me gives me a lot of confidence when I'm doing my first layer of due diligence, for sure.
And how would you help someone determine whether alternatives are even a good fit for them? Do you guys look at risk tolerance or financial goals? I mean, maybe it's all of it. Tell us a little bit more about how that comes into play. Because I'm sure there's some clients that it's just not, I've told people we're not a good fit. You should not be investing in this.
Sure. I would say the right alternative is right for just about everybody, right? Because I feel so strongly about this business, this asset class. In full transparency, I have a lot of different types of assets. I've got money in the stock market, I have money in the crypto market, but my core portfolio is alternatives focused, right? And you can develop an alternatives portfolio that funds your lifestyle, right? That funds your fixed expenses. That's where our clients are trying to get to, right? If our cost of living is $10,000 a month, I want my core portfolio to pay for that. And then anything else in my portfolio, I kind of look at as also like fun money. But I would say the only time an alternative asset is not right for somebody is if they're not willing to do the due diligence and take the education it takes to understand the investment. right? So if you are just so busy and you can't take 30 minutes a week, an hour a week to educate yourself on how these alternative investments work, to do due diligence on the operators, then I would say, and that's fine if that's the answer, right? Because different people are going to have different ways on how they want to spend their time. Then invest in the 401k, invest in the stock market, be okay with how the volatility works. But I would even say, if you're that type of investor and you want to call up your broker, and you see your portfolio is down 10%, you should probably know why that happened, right? So there's going to be some level of education required for any investments, as long as you want to be a good steward of your assets.
Yeah, and I will say that I don't know that there's anybody that Central Lending currently works with, which was a referral from you, that has the same situation. It's not cookie cutter. I mean, there's some similarities for sure. Some are more cash flow focused, some are really growth minded, some are still actively working with, W-2 income coming in, some are retired, they all have a different story. But I don't know that there's anybody that I've at least spoke with, and we've helped a lot of your clients deploy some capital that have the same situation and story, and I think where people benefit working with organizations like you guys is really giving them that path, right? A lot of them will come to me and say, well, we've heard we should be doing this. And sometimes they don't even know what their end goal is. It's like, well, we were told this is what we should be doing. Our neighbor does it, or our family member, but they don't even really know what they're trying to accomplish. I think that's where you and Chris really do a great job, is just kind of giving them that path from point A to point B. If this is what your end goal is, this is how you get there.
100%.
And they're all, everybody's so different within your community.
Everyone's different within our community. And I'll extend that to just the population in general, right? No two financial plans should ever be the same, because no two individuals have exactly the same goals. And so if you're listening to this call right now and you're thinking, okay, like, how do I get started, right? The best piece of advice is number one, get really clear on what your goals are, right? So we're obviously talking about money and investing. So I'd say, when do you want to retire, right? Quote unquote, retire. How much money are you going to need in retirement? If you're, investing your 401k and you want to follow the 4% rule, what does that look like? If you're investing in alternatives and you need $10,000 a month, how are you going to get there, right? So really get crystal clear on what your goals are. And then you have to work backwards, right? Okay, and you're at point A, you need to get to point B. Is that realistic, right? And then how are we going to do that? I think that is the critical question that every investor needs to ask first, right? Before, what do I invest in and who do I invest with?
Yeah. I've even had one of your guys' members of your community say, well, we didn't think we had enough money to start working with them. And I was like, that's really interesting, because you guys do have very high net worth individuals that have done very well for themselves, and people that are really just starting. So I don't think any amount is too small. Now, just for clarification, there are some alternative investments that do require you to be what's called an accredited investor. So if you aren't at that place and you qualify from that status, you will be a little limited, but there's still options. You guys have done a great job with some of your members that aren't quite accredited yet. So and to be honest, like, not every job has a 401k or a pension anymore. Like, it is our responsibility to be good stewards of our money, like you mentioned. So this is, obviously an option for that.
Absolutely. And it's crazy. I'm so glad you brought up that point, because it's crazy how many people think that they don't have enough money to invest in the alternative space. We can, get started with a decent amount of capital, right? You don't need hundreds of thousands of dollars in order to get started. The best time to start, is today, right? If you're looking to get going, you don't need a ton of capital. I will say, it's important to look at your balance sheet. If you have some debts, is it good debt or is it bad debt? It's really important to prioritize kind of the order of operations. But once your balance sheet is solid, I would say the biggest risk that I'm seeing right now is people that have too much money in cash, right? And the reason I say that is because it doesn't matter who is in the White House, the money printer is not going to stop, right? So regardless, inflation is real. You can go to Chipotle and see that in real time, right? I went last week, and my burrito bowl that used to be $9 is now $17, right? And that's just one example of many of pricing getting more and more unaffordable, right? So I'd say you need an emergency fund, right? That's going to mean different things for different people. That is step number one. And I'd say outside of that emergency fund, right? Once you're comfortable with the ability to, cover expenses, if there's a job loss or, a family event that you don't foresee, then you need to have a really solid investment plan, because with inflation, asset prices rise, whether it's stocks, real estate, investing in notes. Really important that you're not left on the sidelines.
Yeah. Well, that kind of segues into my next section I wanted to talk about, is the different types of options in the alternative space, because there's a lot. I'd love to tell you all that there's only debt funds and we have the best one, but
you guys have a very good one. I'll say that.
But maybe you can touch on that, is because you guys work with a lot of operators like us.
Sure.
There are a lot of options out there, and I do believe in diversification. So maybe let's talk a little bit about that. Some of them that are your favorites.
Yeah, I would say for me, I'd say the gateway to alternatives is physical real estate, right? That's kind of the easiest thing for most people to get on board with. Why is that? It's because it's easy to see the profit and loss of an investment property, especially if it's a single family home, right? We can feel it, we can touch it, it's tangible, it's real. Yeah. To real estate 101, we want to buy cash flow positive properties. And that's tough to do in a lot of markets, right? If you're in, the coast, in the Sun Belt where I am, oftentimes, given how high interest rates are right now, it's very tough to find cash flow. So basically, what does that mean? That means you take your rent that you receive from your tenant, you subtract all the expenses, mortgage, property management fees, reserves, and you want some money left over, right? So I'd say that is, a great place to get started. The Midwest is a really good market right now to look at if you want cash flow. And, a lot of people love real estate, myself included, but sometimes, once you have a bunch of houses and you get calls from tenants, that there's, a leak in the roof, somebody's not, I didn't realize when I was a long-term renter in New York that paying rent was optional, right? I never missed my rent payments because I didn't want to get booted from my place of living. But as a real estate investor, we can all agree that sometimes tenants, don't pay or they pay late. And so there's a lot of headaches, right, that come along with being a real estate investor. But once you kind of start in that realm, right, then it opens up a whole new world of, okay, wow, I could actually invest in something that gives me cash flow. So real estate's a great one. Obviously, different debt funds, right? We love debt funds, or I do. We love them at Money Ripples because it's really true mailbox money. The big risk there is you want to make sure you're investing with somebody you know, like, and trust, and you're well educated on how they make money. We talked about that earlier. So central lending, obviously, a great option. We like short-term lending. Obviously, that's an expertise that you guys have as well. I love being in first lien position on notes, right? So that's critical when we talk about capital preservation, principal risk, being in first lien position on notes. We love that. I also love investments in oil and gas. I love investments with precious metals, gold and silver, with land. Gosh, that's another asset class that can be a really interesting place for people to look. And then, we talk about the syndication market, right? So that's basically investing in a single asset that a general partner is going to make improvements to. It's been a roller coaster on the syndication side over the last few years, and we could have a whole separate podcast on that. But kind of reinforcing the fact that if you're with the right syndicator who knows what they're doing, can be a really great way to grow your money. I'd say probably a little bit more high risk than the debt funds or the short-term lending. But gosh, there's a ton of opportunities out there. We had a client recently who told me that he wanted to invest in a Colombian coffee company, right? And I went through the due diligence with him, and when it came down to it, he just was really interested in the investment, right? He loves coffee, and he's actually going to fly down to Colombia to see kind of how the sausage is made. And I told him, I said, the coolest thing about this investment is, it's diversified, right? So if something happens to this coffee investment, I would classify that as high risk. His balance sheet's not going to blow up, right? It would be painful, but he'll move on. He'll be okay. And I said too, it's really important when it comes to investing that you're having fun as well, right? Too many people think about investing and it's like, okay, money investing equals stress, right? I understand that. But as you become more educated in where your money is going, it should be fun as well. And you should have some investments that you're actually really interested in. And even if it's not the highest yielding investment, it's not all about chasing yield, right? A good portfolio is something that you enjoy managing, that you enjoy overseeing, and that it's fun to learn about, how your dollars are being put to work.
I love that. And also understand what you're investing in. That's one thing I've always said. If I don't understand it, I'm not investing in it. And you should understand who you're investing with. I think the product you're investing in is as important as the operator that you're investing in. And you've mentioned this a couple of times already in the short time we've been talking about is, knowing who this operator is. What is their track record? That's a big one for me. If this is an operator that's always been in the single family space and now they're going to go do oil and gas, I would question that. It's like, you've always been in the residential market space for 20 years and now you're going to oil and gas, and vice versa. So track record is a big one for me, and not just the perfect track record. I'd like to hear about wins and losses and how they actually overcame those, because any operator that tells you they've never had challenges and it's always been all successes is probably not being that truthful with you. So, I want the transparency, I guess, is what I look for.
100%. And I'd say when you're looking at different operators, right, you hit the nail on the head, Heather, when you said, we like people that do the same thing over and over, but they do it very, very well, right? Best in class. Like if I talked to you next week and you said, Central Lending, we're going to start trading currency derivatives. I would maybe question if I want to give you guys money for that endeavor, because you've never traded currency derivatives in the past. What you guys do is lending, and you do it well, and you do it better than anyone, right? In your field. This is me saying that, not you guys. So I'm very comfortable investing with you because you do the same thing and you do it over and over and you do it very well, right? So really, really good point. When you invest with somebody, what's the track record? How long have they been doing it? Have they been doing it in the same area as well? I think it's really, really important questions to ask. Yeah,
and on that, let's just segue into due diligence and kind of risk management, because I think you guys do a pretty awesome job advising people on how to do that. What steps would you recommend an investor take before committing capital?
Love this question. And as the years have gone on since I've been in this space, my guidance on due diligence gets to be stronger and stronger every year, just based on experience, based off of the market, seeing what's happened. I would say due diligence is going to be very tailored to the type of investment that you're reviewing, right? So say you are looking to buy a single family home. In 2021, interest rates were at 3% on mortgages, right? Yeah. It was very difficult to do due diligence then because homes were selling so fast, right? And in retrospect, I think a lot of investors now have buyer's remorse because they bought a property, it looked great on paper, tons of issues, right? Yeah. I'd say when it comes to physical real estate, you need to see the property in person. This is just, from my own personal experience. Yep. Fly down there if it's not in your backyard. I would even take it a step farther and say, do your walkthrough with the inspector, right? If you're going to have an inspection done, which you should, I've told people, hey, if you go with the inspector and they're pointing out, what's happening behind the curtain, you will have a lot of confidence that the house you're buying is going to suit your long-term needs, right? So I'd say number one, when it comes to physical real estate, see the property in person. When it comes to the more passive side, right? When it comes to funds, syndications, I would say obviously number one is you need to be really comfortable with the investment operator. Have multiple phone calls with them. Ask all the questions you need to, because these are your hard-earned dollars at risk. And I would say go through the financial statements, right? And they should be audited, right? I think that's really critical. It's not foolproof, but it's a huge step that, yes, there's an independent third party that's reviewing these financials. And you don't need to be a CPA, right, in order to understand financial statements. I'd say that's a great general rule of thumb for people. It's like, oh, I don't understand how to read these. All you need to know is, if I'm talking to you, hey, Heather, can you walk me through the financials and talk to me about, if I'm going to give you $50,000 to invest, what's the cash position of Central Lending? Like, how do I get comfortable that you guys have the business operations in place to know that I'm going to get paid every month or every quarter, right? Just can you kind of show me on the financials where those numbers exist? And if you can get comfortable with kind of that type of discussion, then it could be a green flag in order to invest, right? And so for a lot of people, that's intimidating. But I think in today's day and age, you really need to go the extra mile to make sure you understand where your dollars are going.
Yeah, and I mean the resources online anymore you could even hypothetically put that in ChatGPT, a financial statement. We've caught fraud with borrowers doing due diligence during our underwriting process before we give them a loan. We've taken bank statements, financial statements, thrown it all in ChatGPT. We've caught fraud, things that weren't arm's length transactions.
Wow.
So the resources are there, and I think also a little bit of is your gut instinct too.
Mm-hmm.
I told people if there's something that doesn't seem right, whether it's a note you're buying, a fund you're investing in, that should be a flag to just stop. It doesn't mean you wouldn't move forward with them, but that should be an indicator that you should be asking more questions. Any big red flags for you that are kind of hard nosed, if you were personally investing your dollars or maybe even for just a client?
I would say you got to use your gut instincts, right?
Yeah.
When you meet with an operator, when somebody's too arrogant, that for me is a hard pass. And then if they say you can never lose money, I mean, I've actually had a few people tell me that. It's like, oh, this is foolproof. You won't lose money with us. That to me is a hard pass. And I would say I want somebody who has expertise, right? I'm not saying I wouldn't invest my dollars with somebody who's kind of just getting started, but I want somebody who's had a couple years, a couple different market cycles, to show me that they really have the experience to manage the risk of the balance sheet.
Yeah. No, those are great advice. I think audited funds is another big one.
Mm-hmm.
I've been around long enough I could tell some horror stories. And you probably know some of the horror stories.
Yep.
Where not in a million years I would have thought some of the operators that have failed would have failed. And that was gut instinct.
Mm-hmm.
And so, gut, I think it's all of it, right? It's all of these things. It's not just one thing. And I think asking questions, being with an operator that's transparent is going to show the good, bad, and the ugly. And I think also understanding how they communicate. That's another big one. I've heard from clients, well, I invested with this firm and nobody will call me back. And it's like, you should have direct access. I'm talking cell phone numbers, emails, and they should better pick up the phone when you call. And if they don't, you better be getting a call back at the end of the day. Those are big kind of red flags that I would look for as well.
Communication, critical, right? I'm glad you touched on that point. You should never be chasing operators, right? If you're giving your hard-earned money to somebody, they should be grateful that you're even considering them, right?
Yeah.
And communication is a standard practice, right? If there's poor email communication, or you ask for a phone call and it doesn't happen, move on.
Yeah. Yeah. I recently had an encounter with a friend's friend that made an investment locally.
Okay.
And the guy had been eluding him for a year. And he's like, it's okay. I know I'll get my money back someday. I said, that's not a year you haven't heard from this guy. And this is on a local property, which really should make you feel a little bit better about it. And so I, of course, go right to the internet, and this guy's got all kinds of problems. Like, he's everywhere. And I said, get your money back. And he's like, really? You don't think that's okay? I said, I will tell you this much. If I had a staff member that didn't call an investor back by end of business, or at least, hey, I'm working on this, they would not have a job at Central Lending. That's unacceptable. Even if it's bad news, right? Nobody wants to give bad news. But I think it's even more important to over communicate when things aren't going well than it is when things are great.
100%. And I'll say this too. Nobody cares more about your money than you do, right? Yeah. So be the CEO of your investment portfolio. Trust but verify, right? We want to take emotions out of it. We want to take personal relationships out of it. I say, gosh, at a minimum, you should be looking at your portfolio quarterly, right? Having a touch point, whether it's email, phone call, touch base with the people that are managing your hard-earned dollars. Ask them, how's it going? Do you see any headwinds in the economy that I should be concerned about? That quarterly kind of updates really, really critical.
Yeah, which also I think sometimes too, investors go into these investments not understanding what regular communication is from that operator. And to be honest, in everybody's defense, like, some investments aren't that exciting. There's not a lot of activity that happens. So to report monthly doesn't make a lot of sense. Maybe it's quarterly. I would say at least quarterly you should be hearing from that operator. But I think the biggest thing is setting your expectations accordingly. I've had clients say, well, I didn't hear from them for a year. It's like, well, it's right in their paperwork that they don't report to you for a year. So understand what you're getting into before you invest versus deploying your capital, and then you're asking all these questions that may not align with what your expectation or what you want is.
There's one light bulb I just had that's really critical too, and that is when you say you should know what you're investing in 100%, you should also know, is the investment designed for cash flow or for growth? Because a lot of people mix that up, especially on the syndication side, right? So people invested 50 grand, 100 grand into these apartment syndications that said they were going to pay, an 8% pref quarterly, and they never got the quarterly payments. Gosh, there's a lot of reasons for that. A syndication historically and typically is designed for growth, right? And the cash flow is really a bonus. But when there's headwinds, when, the construction is over budgeted, the general partner is going to pay the people to, do the construction before they're going to pay you, right? Versus other funds like a short-term lending deal, right? Some debt funds are made for cash flow. So I think really important people understand, is this a growth play? Is this a cash flow play? How am I being paid? What is the end goal? And make sure that aligns with your investment objectives. Also
liquidity, because you brought that up earlier. You have some clients that need more liquidity than others. That's another big thing I get. I had a call today. Well, that fund, and it wasn't our fund, it only gives you your money over a year. You get 25% of it once a quarter. And I'm familiar with this fund. And I said, yeah, that's what their offering documents say. Well, I didn't know that. It's like, and so that's a big one too, liquidity events. I mean, people are planning for the future. Maybe you've got a kid getting married, somebody going to college. So how do you guys address liquidity when you're kind of looking at and advising people, different strategies?
Love that question. Because that really is, if you talk about the stock market, what's a pro of the stock market? And it is the concept of liquidity, right? The ability to get in and out of positions quickly. And I'd say on the alternative side, we want to make sure we don't run out of money, right? That's a really important one. And you want to make sure your assets are not locked up for too long, or you just want to make sure you understand what the lockup schedule is, right? So, we'll talk, when we talk to clients, especially new ones, we talk about life events, what's coming up, how much cash do you need to have on the sidelines, It's also another reason why we really focus on whole life insurance or infinite banking.
Yeah.
It's a great way to kind of be your own bank, have liquidity. We should probably do a separate episode just on that, because that's a whole nother really cool, I'd say, alternative asset feature that a lot of our clients utilize. But really making sure that you have enough as an emergency fund, and that when you do make an investment, you understand how long your capital is tied up for. And if you have, a wedding to pay for, if you have college education to pay for, you probably shouldn't be, if it's like a 2-year or less goal, probably shouldn't be investing in a deal where your capital is going to be tied up for too long.
Yeah, that's a good point. And understand that before you make the investment.
For sure. Yep, that goes without saying. Absolutely.
Yeah. Well, I was hoping that maybe you could share an example of a client, no names, of course, but just maybe give us an example of a client that came to you guys and that you strengthened their portfolio or their situation by adding alternatives to it. Just kind of a real life example.
Oh my gosh, we have a lot, right? And what I love about that question is it's so unique to the individual. And we get our clients' results, right? I had somebody before. They said, "What's your success rate?" And I said, 100%, right? It's because it's not like we know what clients want, and then we can connect them with the right people in order to achieve their goals. One that comes to mind is we have a young couple. The husband's an entrepreneur. The wife is a nurse, and they recently had their second child, and they came to me about 2 years ago, and they said, "Hey, we need about $5,000 a month in cash flow. We want to be work optional, at least the wife did, right?" Mm-hmm. And she sent me an email literally a week ago saying that they had achieved their goal, right?
That's cool.
Which is amazing. And there's some tension and drama in her workforce. And she has the ability, unlike, unfortunately, a lot of her colleagues, that if she wants to step away for a litut bit, she now has the means to be able to do that, right? And so for her in particular, we actually, we repositioned some retirement assets, put them to work, put them in some investments that pay monthly and quarterly. And she is, I'm not going to say who it is, but she is a client of Central. That's part of her overall portfolio. And now she has the confidence to, hey, gosh, if we need to take a step back, we can actually do that. And it's funny too, talking about inflation. She said, gosh, we had this as our goal and we hit it. And she goes, things are more expensive, so we need to maybe up that goal, into the future. But the wheels are in motion, and very, very important part, of your overall happiness in life is not being super reliant, on one job or one source.
I love that. Now you had a slide you wanted to share, I believe, right?
Let's see if it was an Excel file I wanted to share.
I don't want to forget that. And I want to be mindful of everybody's time. I don't have a hard stop at the top of the hour, but I know for a lot of you, it's not 4:00 like it is almost for me.
Let's see if this works. Can you see that screen?
Let's see. Oh, here, I'll add it to stage. Let's see.
Perfect.
I think we can see that now.
Excellent. So this is a really powerful example of the difference between investing in the stock market versus investing in a fund, right? And so this is a specific example of one part of a client's portfolio that we are investing in. And he's looking to retire in about 6 to 7 years. Okay. And that's going to be able to when he can start drawing tax or penalty free from his IRA, right? So he had a simple, we helped him open a self-directed simple. And I did a quick comparison over, okay, this is the stock market. This is what we can get when you're compounding your dollar. So you see stock market, I use 8.49%. That's historical to date, the average return of the market. It's been pretty high the last couple of years. What we haven't seen in the markets though recently is a big drawdown, right? Which it will happen at some point. It happens quickly. It's not like we have notice when these things happen. And so for all the stock investors out there, just be ready. for a drawdown. It's going to happen at some point. But let's just assume, 8.49% historical average versus a fund that's compounding at 14%. It's on the higher side, but it is an achievable return. And you're going to contribute annually, on the simple, he's going to do about 19.5, almost 20 grand a year. So if you look at the differences, right, between the 6-year outlook, you've got $350,000 versus, about $450,000. And that assumes no drawdowns on the market as well, right? So if there's a big 20% pullback, that number is going to be even more stark. And then the real kicker, though, Heather, is when you start to draw the funds, right? When you need to live off of it. So if you do the 4% rule, right, which I think might even be a little generous, I'd say it's probably closer to 2 or 3%. Look at the monthly cash flow there, $1,100 a month versus if we then go from compounding to payout at 13%, about $4,800, right? So a massive difference in terms of your monthly cash flow, right? And I'll say this too. When you have, Chris and I really focus on kind of what's the concept of being a broke millionaire, right? And so that's, I've got $1 million in the stock in my 401k. I have 2 million, and that's great. I mean, that is an achievement, right? That means you've been dedicated for decades growing this portfolio, and that's to be commended. But I think the reality of a situation can be very different when you're living it, right? Versus like, I've got this money in the stock market. I can withdraw 3 or 4% a year. On $1 million, that's only $40,000, and that's pre-tax if it's a traditional 401k. That's not going to get it done in a lot of situations. So I don't say that to scare people. I say that just to be aware of what's possible in retirement, I think is really critical. Education, transparency is the key, and goal setting, right, is the key to success.
That's great. And I couldn't agree with you more. I have a mother-in-law that unfortunately had a very bad financial advisor. And it could have been a very different situation had we been asked to help her years ago. And she did not understand that she was basically just drawing down her account. And so. Oh,
I hate stories like that. I really do.
Yeah, especially when it's your family, like, wow.
Sure.
But it happens all the time. It's a very common story. So as we kind of wrap things up, what would be your advice to someone that's brand new to alternatives? What do you think a first step would be for somebody like that?
2 pieces of advice I think are critical. Number 1 is be clear on what your goals are and start small, right? You don't need to have a goal of $20,000 a month right off the bat. I'd say have a goal of $500 a month if you're just getting started, right? If you're on this call, you have the ability to generate $500 a month passive, right? I have a lot of confidence in that statement. Start small. Once you can do $500 a month, you can do 1,000. Once you do 1,000, you can do 2, you can do 3, and so on. So don't think super big picture. Think, okay, how do I get to $500 a month in passive cash flow? Number 1. I'd say number 2, start small, right? So even if you have $1 million to invest, right? So you have $1 million in the stock market. Start with one small deal. Maybe it's 25,000. Maybe it's 50,000. Get really comfortable with how the investment makes money and get comfortable with the risk. Right? Because it's pretty jarring to put hundreds of thousands of dollars to work right off the bat. So start small, get comfortable, see proof of concept, right? If someone's, if an operator says, okay, we're going to pay you monthly, make sure they pay you monthly for 3 or 4 months before you give them any more money, right? So make sure the operations are tight, make sure the core values of who you're investing with are in line. And that way it's kind of a good risk adjusted way to build a portfolio.
I love that. I really do like that because I've had those calls where I have one today. He's got 2 million. He's ready to put it to work. I'm like, why don't you just put the minimum in?
Yeah, right.
Prove everything that I tell you we're going to do, and you can always add to it. Because you go from one extreme where people don't think they have enough to the other extreme where they have this large influx of capital, whether it's from selling a business or they've just done a very great job saving all their lives, but they're ready to go. And it's like, I love the proof of concept.
Yep.
Last thing, do you have any favorite resources, books, tools, podcasts, anything like that? I mean, there's just the day and age we're in now. I love that there's so much information at people's fingertips. So any of your favorites that you want to recommend?
Sometimes there can be too much info, right?
I know.
Definitely check out our podcast, Money Ripples, with Chris Miles. A ton of good content there. And we focus on tactics, but we also focus a lot on mindset, which I'd say is, we haven't even touched on mindset, but a critical component to investing, having that abundant steward focused mindset, really important. We focus a lot of our time in our episodes on helping investors, with that part of, their finance and investment plan. So the Money Ripples podcast, highly recommended. Check it out if you haven't already.
Can they get in contact with you guys to explore options to work with Money Ripples through the podcast link, or
through the podcast or through the Money Ripples website? Yeah, just Google Money Ripples with Chris Miles and schedule a call with one of our onboarding specialists if you're interested to learn more.
Okay. Well, let's see here. I want to put this up. I really appreciate having you here, Craig. I always enjoy our conversations. I'll be coming to Tampa soon, so we'll have to get together, do dinner or something. I need to explore Tampa. We always go to Lakeland, where Central Lending's at, so I think I need to spend an extra day or two on one side or the other of my trip and come explore Tampa.
You need to. We'll show you the good restaurants that Tampa has to offer.
Absolutely. But thanks again. I really do appreciate it. I know this is later in the evening for you, and you took an hour out of your day to be with us. For those of you again that want to connect with Money Ripples, they've got a website. They've got a great podcast. I don't think you can overeducate yourself when coming to alternative investments. I've also put a QR code up. This is a link to my calendar. If you want to connect, talk more, please, by all means, use the QR code. My email is also up there, heather@centrallending.com. And I just thank all of you for being here. Hopefully this is valuable to you. I just really believe strongly in educating yourself. You are the best steward of your money. You care the most about your money. So hopefully this gives you some tools to arm yourself going out there looking at some alternative investments. And thank you, Craig. I appreciate you being here.
Amazing. Thanks for having me, Heather.
Okay. I'll talk to you soon.
Talk soon.
Bye.
Bye-bye.